Here's a stock trading at fresh highs, moving up more than 30% in a year. And yet its beta tells you it should be one of the calmest, most boring stocks on the market. That contradiction alone should make you pause. Because when a low-volatility stock starts flashing warning signs usually reserved for hot, speculative names, something interesting is going on underneath the surface. Today we're breaking down National Presto Industries, ticker NPK. And by the end of this video, you'll understand why the numbers here don't all agree with each other, and why that disagreement is exactly what makes this company worth studying. Let's start with something most people would never expect from a publicly traded company. National Presto has only 7.17 million shares outstanding. That's tiny. And if you look at the float, meaning the shares actually available for public trading, it's even smaller, just 4.84 million. Average daily trading volume is only around 87,000 shares. In simple terms, this stock doesn't trade like a typical big company. It trades quietly in small amounts, almost like it's flying under the radar. But here's where things get interesting. Insiders, meaning the people running the company, own nearly 32% of it. Institutions, the big money managers, own almost 62%. That means the vast majority of this company is held by people who know it extremely well or who have done deep research into it. When insiders own that much of their own company, it usually means their financial interests are closely tied to how the business performs. Now, let's talk about price. Value investors love asking one question: am I paying too much? On the surface, a PE ratio of 23.39 might not shock you. That's a fairly normal earnings multiple. But here's where the story gets more complicated. The price to free cash flow ratio is nearly 38. That's a big gap. Normally, when a company earns money on paper, similar cash should be flowing into the bank. So why is investors paying so much more for the company's actual cash generation than for its accounting profits? Hold that question, because we're going to answer it later. And the answer says a lot about how this business operates. Before we go there, let's talk about something that might confuse even experienced investors. National Presto has a current ratio of 5.22. If you're new to investing, the current ratio simply measures whether a company has enough short-term assets to cover its short-term bills. A ratio above 1 is considered healthy. A ratio above 5 sounds incredibly safe, almost overly cautious. But then look at the quick ratio, which is a stricter version of the same test, one that removes inventory from the equation. That number drops all the way down to 0.91. So what happened? Why does the company look extremely safe one moment and only moderately safe the next? The answer is inventory. A huge portion of National Presto's short-term assets are sitting in unsold products, not cash. This is your first pattern interrupt, because it tells us something about how this business actually operates day to day, not just how it looks on a balance sheet summary. Speaking of the balance sheet, here's something that genuinely stands out. Debt to equity is just 0.02. That is about as close to debt-free as a real company gets. Total debt sits at only $9.18 million, while cash sits at $16.29 million. That gives the company a net cash position, meaning it has more cash than debt, of $7.11 million, or roughly 99 cents per share. In a world where many companies load up on debt to grow faster, National Presto is doing the opposite. This is the kind of balance sheet that doesn't panic during tough economic periods, because there's very little financial pressure weighing it down. But strong balance sheets don't automatically mean strong profitability. So let's look at how efficiently this company turns sales into actual profit. Gross margin sits at 16.47%, operating margin at 9.33%, and net profit margin at 7.86%. These are not explosive high-margin numbers like you'd see from a software company. This is a company that manufactures physical products, and those margins reflect that reality. At first glance, that might sound underwhelming. However, one number changes the picture a bit. Return on invested capital sits at 9.95%. While the company's cost of capital, meaning what it theoretically costs to raise money, is only 6.72%. When a company earns more on its investments than it costs to fund them, that's usually considered a sign of healthy, disciplined management. It's not a flashy growth story, but it is a profitable one. Now, remember that earlier question about why investors are paying so much more for free cash flow than for reported earnings? Here's the answer. In the past 12 months, National Presto reported net income of $42.81 million. But operating cash flow, the actual cash generated from running the business, was only $33.47 million. Normally, cash flow tends to run higher than net income, not lower, because non-cash expenses like depreciation get added back in. Here, depreciation was only $5.66 million, not nearly enough to close that gap. This tells us that a meaningful amount of the company's paper profits are tied up somewhere else, likely in that same inventory we talked about earlier. After subtracting capital expenditures of $7.03 million, free cash flow comes out to $26.43 million, giving an FCF margin of just 4.85%. This is exactly why the price-to-free cash flow ratio looks so much higher than the price-to-earnings ratio. The company's profits and its actual spendable cash are not telling the exact same story. Let's shift to something income-focused investors care a lot about, the dividend. National Presto pays an annual dividend of $1 per share, which comes out to a yield of just 0.72%. That's fairly small, but here's the twist. The payout ratio, meaning the percentage of profits paid out as dividends, is only 22.28%. That means the dividend is very conservatively covered by earnings, leaving plenty of room for the company to maintain or even grow it without straining its finances. Interestingly, the buyback yield is negative 0.25%. Meaning the number of shares outstanding actually grew slightly rather than shrank. So while the company isn't aggressively buying back stock, it also isn't stretching itself to pay dividends either. Now here's a pattern interrupt worth paying attention to. The stock's Relative Strength Index, or RSI, is sitting at 69.32. In simple terms, RSI measures how overbought or oversold a stock might be, and a reading close to 70 is typically viewed as a caution zone, suggesting the stock has been heavily bought recently. Combine that with a 50-day moving average of 127.89, sitting above the 200-day moving average of 124.38, and you get a textbook short-term uptrend. But remember what we mentioned at the very beginning. This stock has a beta of just 0.46, meaning historically it moves with less than half the volatility of the overall market. So we have a low volatility, quietly traded stock suddenly showing signs of short-term heat. That's not something you see every day. And there's one more twist before we wrap up. Short interest, meaning the number of shares investors have bet against, sits at 306,714, up from 297,632 the month before. That's 4.28% of all outstanding shares and 6.33% of the float, the smaller pool of shares actually available to trade. With a days-to-cover ratio of 3.68, it would take short sellers almost 4 average trading days to exit their positions if they wanted to. It's not an extreme level of pessimism, but the fact that it's rising is worth noting, especially on a stock that just hit new highs. The Piotrowski F-score, a measure that checks a company's financial health across 9 different tests, comes in right in the middle at 5, neither glowing nor alarming. National Presto isn't a company that fits neatly into one simple narrative of strong or weak. It's a business with real financial discipline sitting inside a stock that's currently showing some short-term heat. So the real question worth sitting with is this: when a historically calm, low-volatility company starts behaving differently than its own track record suggests, is that a temporary moment or the beginning of a new chapter for the business?